Welcome everyone. Today is what? Last day of July, July 31st. Market just crashed, more or less. If you want to consider that a crash, the Dow was down over 300 points. It was an interesting day on the markets. Options volatility went crazy today, which happens on big down days, so it was a very instructive day. Well, I'm here today at SMBU in Manhattan, and we are talking to the college summer program guys who are here with us studying equity trading and options trading. And today is a follow-up on a lecture we had last week in which we started to talk about index options and the way that index options work, which is different than stock options, because you can't buy an index, you can't assign someone an index. You can assign someone 100 shares of Google, but you can't assign someone the SPX index or the Russell 2000 index or NDX or so forth. So essentially, these trades, these options basically exist, among other things, to allow people to protect their entire portfolios in one direction or another. The way we're using these options, though, is actually just using the options as option structures, or what are called options combinations, or option spreads is another term for it, to basically take advantage of the fact that options have a time value which dissipates and disappears by expiration. And so if you sell them and they expire worthless, then you would make money on those because they would lose their value. So whatever you received, that value goes down to zero and you get to keep what you received. So we discussed Condors last time, which is a very popular option strategy, and it's easier to understand than some of the other strategies, because what you're basically doing is selling a call way above the money, selling a put way below the money. So you are receiving cash for those options that you wrote. Selling it and writing it is the same thing. And then you buy a protective put lower than the one you sold and a protective call higher than the one you sold, so that if the market goes crazy in either direction, there's a limit to your risk. And so that's essentially what a condor is. And unlike equity options, with index options, these are cash settled. So basically, these are literally insurance policies, as we discussed last time, and you are paid cash if your option, if your short option, if your long option that you purchased is in the money, you're paid cash for that. If the short option that you sold is in the money, you owe someone cash for that. So these are what they call cash settled options. And so these are all I trade, for example, are index options. And so this is a subject near and dear to my heart. So basically, let's go back just to refresh your memory. I set up 7 weeks out from the March expiration of 2014. In other words, I guess about 6-7 months ago. I set up a 49-day, a 7-week iron condor, which would be a fairly typical iron condor. Most people start them anywhere from 7 to 9 weeks out from expiration. There's reasons for that, but it's a little advanced, and we won't be getting into that, why you would start so early. But just think of it from a logical standpoint. The farther out you are in time, the more risk there is that a faraway strike could actually get hit by the market. So therefore, you're going to get paid more if you start 7 weeks out than if you start 4 weeks out. On the other hand, there's more risk of your getting into trouble on that trade because the market has more time to create problems for you and actually to hit your short strikes in the case of an iron condor. So let's take a look at another example of an iron condor, but this week we're going to give you an example of where the market would have forced you to modify the trade, or what we call in options trading, adjust the trade, to deal with what the market has done, and then you can see how that adjustment is healing to the trade. So let's first take a look at what the market was doing in the NDX. The NDX is the NASDAQ 100. It's the big name names within NASDAQ. And so as you can see, it's been rallying basically with the rest of the market since the middle of November 2012. And this is a daily chart showing what was going on with the NDX up around the day that we put this trade on in January. So if everyone just takes a look at the chart there, you can see it was, it's in a very bullish mode, and it had experienced the week before some pretty big sell-offs, but it was starting to come back. So all we did here was on this day at 10:30 in the morning, the NDX index was trading at this was the last day in January, and it was trading at exactly 3,500, interestingly. So what we put on here was an iron condor where we sold the 3750 put. That's 250 NDX points above the market. And we also sold the 3200, which was 300 points below the market. And so if you want to see a sort of a graphic image of what the risk of this looks like, it's essentially if the market ends up anywhere between this 3,700 plus area down here or the 3,200 plus area on the put side, we're going to make money on the trade if we do nothing to the trade and we just leave it alone. So and you can see why this is attractive, because basically the NDX hasn't been up for years and years and years in that 3,800 level, and it hasn't been down to that 3,200 level for what, 1, 2, 3, well, somewhere 4 or 5 months ago was the last time it was down there. So all we're asking the NDX to do for the next 7 weeks, stay within those two boundaries, and we're going to make money. So you can see why this is an attractive trade to a lot of people. And you can also see that it's highly probable, that will occur statistically. Let's see. We'll go here, 3,500, right? So 3,500. I got to do, just to do this correctly, I've got to fill in the proper implied volatility number in my model here. And this trade has an 84% statistical probability of profit. That's just pure statistical analysis. So you'd say, hey, why not just leave it alone and let the statistics do their thing? Well, the problem with just leaving it alone is, on this trade, for example, in the 16% chance that the market goes to, it pierces those points and stays there, we could lose $10,000, $11,000. And this is on a trade where the best you can make on it is 35.20. So if that happens to you, it's going to take you 3 months to make back the profit that you lost from that trade. And so nobody I know of trades iron condors by just letting them just sit there and not dealing with anything that's happening in the market. Or most people do not do that. Most people do not let the trade get out of hand P&L wise, even if statistically it's supposed to work out most of the time. So let's take a look at, and all this should be a little familiar to you from our last discussion. This is an iron condor. I put the shorts on, the short part of the iron condor, I put on it what's called 8 delta, which statistically is, I try to put it on under 10 delta on both the call side and the put side, and statistically that means there is only an roughly an 8% chance that that the market will close above that price on expiration day in March. And the same thing for the 3,200 put. There's only, in this case, a 9.6% chance that the market will close below that level. And intuitively, you could just kind of see that it's, as we just discussed, it's pretty unlikely based on the market behavior of the last 4 or 5 months. So let's take a look at what happens. Now, let's take a look at the risk graph a little bit more closely here on iron condor. You can see that if the earlier in time the trade moves really strongly, the earlier within the trade that occurs, if it were to occur, the more trouble you're going to get on the trade. For example, if the market on the day one shot up 90 points, which can happen on the NDX, that's not like an impossible thing. The NDX can move pretty hard sometimes. then the trade would already be down 2,400 bucks if that happened on day one. So what we do with these trades is before they get into serious trouble, we adjust them. We basically take the troubled side of the trade and we move it farther out of the money, whether it's on the put side or the call side. And that's called rolling one side or the other of a condor. So I'll show you an example of that in a minute. But and normally we'll do that when, let me ask you a question. When the market rallies, which is about to happen in this example, when the market rallies, let's analyze what happens to each of the options here. We've only got 4 options in play here. Let's see what happens to each one of them. What do you think happens to our long put position down here at 31.75? It what? It decreases in value, correct. What do you think happens to our short put? What happens to its value? Does it go up or down if the market's rallying? Well, its P&L goes up, its value, the value of that option. The market doesn't care if you own it or don't own it. It's going to put a price on it. What's going to happen to the price of the put? It's going to go down if the market rallies, right? So since we're short that one, is that one going to be helping our position or hurting it? Helping. How about the long put protecting it? That'll be hurting us. How about the long call at 37.75? If the market's rallying, is that going to be helping us or hurting us? Helping. How about the short call? Hurting, exactly. So we have a lot of hurts and helps here, right? Let me just give you a quick hint. All of the issues, the only one that matters to me in a rally is this short call here. All the help we're getting from everything else is nowhere near the hurt we're going to be taking from that short call. And they're going to, this side, this call, and this credit spread down here are going to be helping us. They're going to be mitigating the problem. But this guy right here is going to be creating a big problem for us, this short call. And so that really is the issue, and that's the issue we're going to grapple with in this trade. So let's see what happens. So let's just go through, we'll go through every day. And we're going to go through every day, just spend a second just seeing what's going on. All right, the market's selling off. Now, sometimes, even though this trade is overall what they call negative deltas, it is also what they call negative vega, meaning that the volatility, if volatility comes up in the market, it's going to hurt this trade, basically because these short options are going to blow up in value. And that's just a temporary phenomenon. So we're not making much progress here. Let's move a couple more days. And so initially, actually, the market sold off. But I'm just giving you sort of a graphic view of it. Initially, the market sold off when we got into the trade, and now we had a big rally day. And on a big rally day, what happens is the volatility comes out of our short options, and the short options are really driving this trade. Why? Because they're closer to the market, so they're having more of an impact on the trade than the ones farther away that are less relevant to where the market is, right? So here, now we had a big rally, and now we're up 1,240 bucks. That's probably actually a bad print. That doesn't look right. Sometimes the end of the day, you know what, I'm going to go to 330 because sometimes end of the day pricing gets a little bizarre and it doesn't make any sense. Okay, that makes a little more sense. So now what I'm going to be looking at is when the statistical probability of either of my short options gets to 20% of ending up in the money. Believe it or not, that sounds like not much. That means there's 80% chance of it not ending up in the money. But if that happens relatively early in the trade, your trade's going to be down some big money. That's how sensitive that short option is that's getting closer. Even though it doesn't sound very close, you've just doubled your probability because remember, we started at a 10% or under. Now we're at 20%. Market's starting to get a little worried. Hey, maybe this strike could get hit. So it's pricing that more. So here we are going to move over to, so when I get to 20, that's my red alert. That when my short call or my short put gets to 20, that's when I am going to do something. What it is it's an early addressing of a problem that could get really ugly. You address it early, And then in many cases you solve it that way. So now we are at February 11th, and we're now going to go to the next day. So what's been happening here is the market has been rallying, and I'll show you the last couple days because we've been going kind of quickly. The market basically sold off right after we put the trade on, and now has been rallying like crazy. So now I got to start worrying about this guy. And so remember, he's at 20 now. Now there's a 20% chance. That's my red alert. So I am going to address this. And the way I'm going to address it is as follows. I am going to, and let's talk about this. When I say roll, what do you intuitively think I mean by that? What do you think I might do?
Put it on to the next month, roll over to the next month.
Well, that's actually a very creative idea, and some people do that. That's not what I'm thinking of doing in this case, and that wouldn't really be an iron condor adjustment. That would be a different kind of adjustment. But that certainly would be an interesting thing to do. What is typically meant by rolling is you close the credit spread that's in trouble. Now, let's analyze what's going on here. This guy I sold for $7.10. I'm buying him back for $16.25. Was that a good thing for me? No. All right. This guy, on the other hand, I bought for $5.35. I'm selling him for $11.45. So that was a good thing. That mitigated my problem. By the way, I'm making lots of money down here. Okay, now, so what I'm going to do in this case is I'm going to roll up both sides, because look what happened here on the put side. On the put side, I sold this for $1.80. It's down to 30 cents now. When I say I sold it for $1.80, I sold the put, I bought the call. The net of those two was $1.80. The net of those two is now 30 cents. So I made money on that put credit spread because I sold something for one price and I can buy it back for a much, much lower price. So that helped me. What was going on the put side helped me. What was going on my long call helped me. But I was getting killed by my short call, and that's why I'm down $1,600 because of the short call. So what I'm going to do is I'm going to roll, and let's take a look at another factor. When I went in and I sold the puts and sold the calls and bought the calls and bought the puts initially, I received a net amount of cash into my account. Remember, because the ones closer are going to have more value than the ones farther, so the net effect of those four is cash into my account, and that cash amount was $3,520. Well, in order for me to be able to replicate, if I want to still make that amount of income in the trade, and I'm going to take a hit here by closing this call side, because the call side I have to buy back for much more than I sold it for, then I've got to basically increase my capital level to get back to that income that I'm looking for. So I'm going to close this side, I'm going to close this side, and I'm going to roll them up and increase to a 15 lot. And you'll see that happen, I believe, here. Sorry, a 16 lot, excuse me. A 16 lot took into consideration that loss I took, and it gave me actually a little bit more potential in the trade than I originally had. So basically, if you think about it, I just closed that original trade. I took off both the put and the call side, and then I reopened it. The put sides moved closer to the market. The call sides moved farther away from the market. So I'm getting paid more for the put side because I've now moved closer to the market. There's now more risk. I'm getting paid less for the call side because I've moved farther away, but I bumped my lot size. So when you do all the math of closing the first one for the $1,600 loss and reopening this one for the larger credit I received, primarily because I bumped my lot size, I was able to restore the credit that I originally received. So, and what I really essentially did was, think about what I did. I moved the trade up. I moved the whole thing up. Well, isn't that logical? I moved it up because the markets moved up. So this type of trading is about reacting. You're not predicting the market, you're reacting to the market. So you already have the information. You just have to learn how to deal with the information that the market's giving you. So this is the new. Remember, the old risk chart was down farther. Now we've just moved this up. So now we bumped our capital level. We got to the same level of credit. And by the way, when you do this now, even though I said you had $3,600 of potential income from the trade, I've actually increased, by going to a 16 lot, I've increased the risk of the trade. So my broker is going to margin me more for that trade. And even though I'm going to make a little bit more money if this thing works out, I actually have a lower return on equity. So that's something to keep in mind with these trades. You can't bump your capital with no consequence. There's a consequence, and the consequence in this case is a lower return. And so what you do is when you're an iron condor trader, you always keep extra capital in your account so that if you're forced into an adjustment, you have the extra capital to do this, which means that the overall return of your iron condor program every month is a little lower than you'd think it'd be, to be completely honest, intellectually honest about it, because you have to keep that extra capital aside. It's got to be there for you when you need to do these adjustments. Still, so in this case, if you do the math of what my broker is going to do, which my software does for me, I am now have the potential of a 10% return, whereas my original trade at 10 lot actually gave me slightly less dollar income, but had so much less capital involved that was actually a 16% return. So so this is a lower return on capital. Still, 10% in 7 weeks is excellent. And of course, you're not going to win every one of these. You're going to take losses, but that's certainly a solid return for a 7-week period. So now let's just move through. We'll go to the end of the day so we don't get the goofy pricing, and let's see what happens. And we'll just kind of walk through. Let's go a couple days at a time. An iron condor is sort of a slow-moving animal. Now, so remember I was down $1,600 when I did the roll, and market keeps rallying, and so it's still coming after those calls relentlessly, right? And but I moved them up, and I'm not going to do anything until the chance of this short call, or if the market whipsaws, reverses, or the short put gets to plus 20. It gets to a 20% chance of being hit. In other words, if my short call has a 20 delta. So now let's take a look at what happened. We were rallying, and all of a sudden you'll notice on this price chart that the rate of increase of the rally is starting to slow down, right? That often happens. The market rallies and then it sort of consolidates in a certain area. While that's happening, while that consolidation is occurring, what good is happening to our trade? Why am I only down now $106 when before I was down like 2,300? Yes.
Theta?
Correct. Theta. Excellent. Excellent. Theta is that part of the options trading world which is the time decay. And since we're net short that time premium, as every day goes by, the market's, it's this number down here, this $228 number. That's what the market's paying me for just taking this risk every day. And you can see that it's a risk because I got hit initially. I took a loss on that call credit spread. But I'm being paid for being in this risk, and I'm being paid by the fact that those short options are decaying faster than my long options are decaying. Why are they decaying faster? Why are the short options decaying faster than the long options? Because they're closer. There's more time premium in them, and therefore that additional time premium is it's burning off at a faster rate because there's more to burn off, basically. So So let's start to move forward here. Now we're down to, remember we started 7 weeks out, we're down to almost 3 weeks out. The market's rallying again a little bit, so it's giving me a little bit of trouble. This is a pain, this trade. By the way, I picked intentionally the month in the last 12 months that had the sharpest rally. Sharp rallies are hard for Condors to handle. And so, I mean, there's no point in showing you a trade where you just put the thing on and it just makes money. You're not going to learn anything. This is what separates the men from the boys in options trading, is the ability to deal with the adversity in a trade. So here is, now we're finally up money after all this time, because look what happened. The rally just sort of stopped. But we had adjusted. It's not really selling off. It's just stopped. And if it just stops, if the market just cools down, chills out, then that theta that we were just talking about kicks in. And we have had so many days in a row where the market hasn't moved much that these options are really starting to lose their value. Remember, they've only got 18 days. Here the market's at 36.57. Our short call's at 38.25. That's 170 points away. It's only got 18 days to get there. Are you going to go buy a call where the market's got to do something extraordinary for it to have any value in 18 days? You might, but you're not going to pay a lot of money for it. And look at what's happened to the value. We sold that one for 560. It's gone down to 274. So that's an example. Now the short call's actually been helping us. And that's because the market hasn't moved much and it lost its value. So let's move forward another couple of days. Just kind of analyze what's going on here. So the market actually rallied a bit from that point. But a slow rally's fine for us, because if it just creeps up, the market continues to lose confidence that that strike is ever going to get hit. And therefore, it's going to put less and less value into that call. And now these puts are, dead meat, because these puts are down at 3,400. There would have to be a 322-point drop in the market in the next 15 days for either of them to have any value. So the market's not giving them almost any value. And so the truth is most traders probably would have taken the put side off right now to reduce the risk, but we can discuss that in a little bit. So let's take a look at what's going on here. This is now 11 days before these options expire. Let's analyze what's happened to each one of them. The 33.75 put is almost, 300 some points, 325 away from the market. I'm surprised you can get $1.45 for that, okay? The one above it is selling for $1.48. That means the spread, which we sold for $1.80, $12.95 minus $11.15, we can now buy back for 3 cents. So let me ask you, yet it represents, I'll tell you how much it represents, 1,600 times 25. What is that? 1,600 is what? 40,000? Okay, $40,000. This represents $40,000 of risk to me, and it's worth 3 cents. I could buy this back for $48. Am I going to expose myself to $40,000 of risk for $48? No. So most guys at this point are closing this side. There's just no point. It's what I call all risk, no reward. You got to get rid of that. And this is called risk management in options trading. You just don't let it sit there and give you potential trouble for no reason. All you're giving up is $48 plus your commissions for buying it back. It's nothing compared to the amount of risk that you've just taken off the table. So now all we've got to do is have the market not get up to that 38.25, and we're going to cash in, on this trade. So let's see what happens. We'll go another couple days. Now our calls are almost, well, these numbers don't even make sense, because sometimes these models give you incorrect prices because there's no way, okay, this makes a little bit more sense. Here we are 8 days before expiration. The market had a big sell-off day, and so now the call side, 38.25, which is now, 175 points from the market, has 8 days to get up 175 points. That's dropped down to 36 cents, okay? So I sold this for $1.50 times 16 times, I can now buy it back for $48. It's $40,000 of risk, $48. This is a no-brainer, right? You spend the $48, you book your $34.78 of profit, and you call it a day. And that's exactly what any sensible options trader would do. You're not going to sit there like a sitting duck with a tiny debit to just close it and you're done and you make your $3,400, and that's what we would do. So that is how you trade an iron condor. It's one way. There's books written about iron condors. There's 1,000 different ways you can do it. There's a lot of fancy things you can do with iron condors, which there just isn't enough time to discuss right now. But the point is the simple act of just moving your condor around with the market and judiciously increasing your capital level. I normally would not go above even 50%. I probably went a little farther than I would in live trading in this particular example. I just wanted to show you how you could have restored your credit. But if you take a look at this price chart on the NDX, that rally that happened right after we got on the trade, that was actually the biggest 30-day rally in the NDX in a year. And just by being disciplined and moving the condor up, we were able to extricate ourselves from the trade with a really, really solid profit, even though, remember, this kind of trading asks for the market not to move. So when the market does move heavily, of course, it's going to be more of a challenge to make money on it. But so last week we discussed just putting a condor on and just letting it sit there and make money. And that can happen. My estimate is that'll happen in a typical year 4 or 5 times out of 12. You just put it on and you'll be able to take it off at a very solid profit. The other months of the year are going to prove challenging, and you'll have to do some kind of adjustments to make the trade work. So, but you learned a lot in the last couple of sessions because we talked about iron condors. We talked about how to adjust iron condors, and you can see even if the market moves outside of its normal parameters, you don't have to lay down and die for the trade. You can do something about it, and what you can do is adjust the trade. And with butterflies or calendars or double diagonals or broken wing butterflies, various kinds of structures that we have in the options world, every one of them has adjustments that you can do to deal with whatever the market's done. So are there any questions? Pretty straightforward, right? So all right, next time we get together, we're going to talk about one of those fancy techniques for adjusting a condor. That'll be a little bit more of a complex discussion, but you'll see you can get very creative with condors as well, and you can take your potential profit and make it significantly higher without creating a lot of additional risk for yourself. So we'll take a look at that next time we get together. So thank you for your attention.